You know what compound interest is. You have seen the chart. The one where $50 a month at 25 becomes something absurd at 65. You nodded. You thought, I should do that. You did not do that. This is not a knowledge problem. Every person who has ever Googled how to start investing already understands the basic concept. The information was never the barrier. So what is? The real barriers. It is never one thing. It is a specific combination of psychological mechanisms that make inaction feel completely rational. And the frustrating part is that each one of them makes total sense on its own. Present bias. The first one is present bias. The version of you that benefits from investing today is not the version of you making the decision today. Your future self at 65 is, to your current brain, essentially a stranger. Neuroscience research shows that when people think about their future selves, the brain regions that activate are the same ones that activate when thinking about strangers. You are literally not wired to feel the same urgency for your future self that you feel for your present self. Loss aversion in investing. The second mechanism is loss aversion applied to investing. Investing requires you to hand over money you have now in exchange for money you might have later. The loss is immediate and certain. The gain is distant and uncertain. Your brain weights these very differently. Losing $100 feels roughly twice as bad as gaining $100 feels good. When markets drop, that feeling is not irrational. It is your brain responding exactly as it was designed to. The problem is that this response is optimized for short-term survival, not long-term wealth building. Complexity paralysis. The third mechanism is complexity paralysis. Investing has enough jargon, enough options, and enough conflicting advice that starting feels like it requires more preparation than you currently have time to do. So you decide to learn more first. You read an article, then another, then a Reddit thread, then a YouTube video. Then you realize there are 17 more YouTube videos. 6 months later, you are better informed and still not invested. Waiting for the perfect moment. The fourth mechanism is waiting for the perfect moment. The market is too high right now. There might be a correction. I will wait until things settle. This reasoning sounds disciplined. It is not. It is a version of inaction dressed up as strategy. Research on market timing is clear and has been for decades. Time in the market consistently outperforms timing the market. The investor who starts on a random Tuesday and stays invested through corrections outperforms the one who waits for the perfect entry point over almost any long-time horizon. The identity problem. The fifth mechanism is the most underrated one. Investing requires you to see yourself as someone who invests. If your current identity does not include that label, starting feels like becoming a different kind of person, not just opening an account. The word investor carries a specific set of associations for most people. Someone who watches markets, reads financial reports, makes active decisions. The reality of modern passive investing requires none of those things. But the identity barrier does not care about the reality. What waiting actually costs. Let's put a number on inaction. Someone who invests $200 a month, starting at 25, assuming a 7% average annual return, ends up with around $525,000 by 65. The same person starting at 35 ends up with around $245,000. Same monthly contribution. 10 years of delay, roughly $280,000 lost to waiting. The most important resource in compound interest is not money. It is time. And time is the only resource that you cannot earn back, borrow, or substitute with effort. Every month of delay has a specific dollar cost attached to it, even if you never see that number on a statement. The people around you. The sixth mechanism is social. If the people around you are not visibly investing, It does not feel like a normal behavior. It feels like something other people do. People with more money, more financial literacy, more stability than you currently have. The problem is that investing is largely invisible. Nobody mentions at dinner that they maxed out their retirement account this year. The people around you who are investing are not advertising it, so you are comparing your behavior to a social norm that may not accurately reflect what the people around you are actually doing. The minimum threshold myth. The seventh mechanism is believing you need more money to start. I will start investing when I have more financial breathing room. I will wait until I can invest a meaningful amount. Meanwhile, most modern investment platforms allow you to start with as little as $1. Starting small is not a compromise. It is a strategy. The habit of moving money into investments is the behavior that matters. The amount scales over time. The habit either exists or it does not, and building it at any amount is easier than building it from scratch later at a higher amount. Fear of making the wrong choice. The eighth mechanism is fear of making the wrong specific choice. Which platform, which fund, which allocation? The fear of picking incorrectly and losing money because of a bad decision you made keeps many people from making any decision at all. Here's what the research consistently shows. A globally diversified, low-cost index fund chosen on a Tuesday afternoon, without extensive research, outperforms doing nothing across almost every measured time horizon. The best investment decision is not the perfect one. It is the one that actually gets made. The one move that defeats most of this. Most of these mechanisms share a common vulnerability. They all require you to make a repeated active decision to invest. Automating the transfer eliminates that requirement. The decision gets made once. Then it keeps happening without requiring willpower, perfect timing, or overcoming identity friction every single month. The version of you that would have spent that money on something else next month never gets the chance. The decision already happened. The automation handles the present bias, the complexity paralysis, the perfect timing problem, and the willpower requirement simultaneously. That is a significant amount of psychological overhead removed with a single setup. What to actually invest in? Since you asked, or since you are about to ask, a globally diversified, low-cost index fund. That is it. That is the answer that most financial research points to for the vast majority of people who are not professional investors and do not want to become one. Index funds work because they capture the performance of an entire market instead of trying to predict which specific companies will outperform. Decades of research show that most active fund managers underperform their benchmark index over long time horizons, especially after fees. Buying the whole market is not settling. It is the statistically rational choice. The one detail that matters more than most people realize is the expense ratio. A fund charging 1.5% annually versus one charging 0.05% seems like a small difference. Over 40 years, on a $200 monthly contribution, that difference compounds to roughly $160,000. Fees are the only guaranteed return in investing, just not in your favor. The objections you're about to make. But what if the market crashes? It will. Markets have crashed repeatedly across history and have recovered every time over any sufficiently long time horizon. The question is not whether markets drop. It is whether you have enough time horizon and enough psychological resilience to stay invested when they do. But I do not have time to monitor my investments. With a passive index fund strategy, you do not need to. Set it up once, automate contributions, and check it as infrequently as once or twice a year. The entire premise of passive investing is that you do not have to actively manage it to get market returns. The question nobody asks: Here's the question almost nobody asks themselves explicitly. What is the cost of not investing? Not in abstract terms. In specific terms, for your specific situation over the specific number of years between now and when you will want access to that money. That number exists. Most people have never calculated it because doing so makes the cost of inaction uncomfortably concrete. Take whatever you are currently spending on something you would categorize as optional. Multiply it by 12 for a year. Assume you had invested it instead at a 7% average annual return. Calculate forward 20 or 30 years. The number will be uncomfortable. That discomfort is useful information. It was never about the money. None of the barriers to investing are fundamentally about money. They are about present bias, loss aversion, complexity, timing, superstition, identity, social norms, minimum thresholds, and fear of imperfect decisions. Solving the money problem is easy. Solving the psychological problem is what requires actual work. The minimum viable action is not finding the perfect investment strategy. It is opening an account, not funding it fully, not selecting the optimal allocation, just opening the account. Because the version of you that has an investment account open is categorically closer to investing than the version that does not. The best time to start was 10 years ago. The second best time is a Tuesday afternoon in the middle of a random month with no particular significance. When markets are doing whatever markets are doing, with whatever amount you can currently afford to move, into whatever reasonable, globally diversified, low-cost fund you can find in 20 minutes of research.
Fine. Subscribe. It won't help, but it might make you slightly less easy to manipulate.